Hi everyone, JJ here with the Art of Value. Welcome. Well, today we're going to look at what famous investor Steve Eisman has been saying. He's made famous through the movie The Big Short, of course. He called the housing bubble, the subprime housing bubble, correctly in 2008 and profited from that. And he was on CNBC again talking about his thoughts on the current market environment, the stock market, what he's predicting. So let's get into what he said. First of all, he said we came into this year where most people were predicting the most anticipated recession that never happened. Given that, he said a lot of people were conservative in their positioning. I think he's talking about fund managers there, and now they're trailing the market and they're trying to keep up. He said so far there's no evidence of a recession, and as long as that's the case, he thinks the market will continue to melt up and people are chasing. Speaking for his own fund, he says some of their positions last year were a little conservative, and as long as the economy keeps rolling along this year, they're going to stay fully invested. The CNBC interviewer observed that yes, the indices have been moving up, but also observed that it's just been a few stocks really. It's been unequal, and Eisman agreed with this. The interviewer then asked him if he's buying the index then, and somewhat unsurprisingly, he said no, we only buy individual stocks. The investors in the fund aren't paying them to buy the index. They could do that themselves. They're paying them to try and beat the market, beat the index, of course, duh. He said their clients are interested in beating the market, but sometimes they're also interested in preserving capital. So he said sometimes their fund does raise some cash and buy more conservative, stately kind of things, meaning the staples rather than more risky stocks and companies. The interviewer asked him that because the market's had a really good run this year, is it time to take some profits off the table and wait for the next run, which is typical of finance media, thinking short term, thinking that long-term fund managers would think about doing something like this. Unsurprisingly, again, they've held some positions for a long time and they don't sell much, and the tax implications of that used to be not great and now they're onerous, so they just don't sell much for tax reasons. This is something that Warren Buffett has said before too. Buffett said the effect of compounding works better if you hold long term because you're not paying so much tax. If you hold long term, you're just compounding away without paying tax. If you're trading in and out of the market, profit taking, as they mentioned there, then you're paying tax and your compounding won't work as well over the long term. By the way, if you're getting value out of this episode, maybe think about subscribing if you're not already to get more of this kind of content in the future. He was asked if it matters to him if the Fed keeps raising rates maybe 2 times more this year. He said maybe 3, and he said it kind of does matter to him in terms of growth stocks because it has a negative impact on those stocks if they keep raising rates. So yes, it does matter. I never really like people talking about growth stocks and value stocks. Buffett's always pointed out that growth and value are joined at the hip. What you really want is both. You want growth at a value price, which is kind of rare. You have to wait for growth to be at a value price. And that's happened recently after the kind of bust in 2022, the bear market. People had already bought, a lot of people had already bought growth stocks at high multiples and they came way down. And it could be argued that that was a good time to buy. It usually is when the market drops as a bear market. That's a good time to buy growth. And what I think Eisman is talking about here is high multiple stocks that are usually trading at high multiples. That's what's meant by growth stocks there. And a lot of growth investors are okay to buy at any price or buy a lot higher than value investors are. Value investors are waiting for a good price, a lower price, which doesn't happen very often. But they're prepared to be patient and just wait it out. That's what Buffett's done over the years. He bought Apple at low multiples, which doesn't happen very often, and it hasn't really happened since. The interviewer pointed out somewhat critically that about 3 months ago, they had guests in all the time who were hyperventilating, he said, about regional banks, the banks getting into trouble, commercial real estate in particular, getting the banks into trouble. And he said now that seems to have gone away. Now we've had this melt up in the market. Nobody's talking about that anymore. Are people worried about it? Is Eisman worried about that? What does he think? Eisman said he doesn't think that that's been removed from the discussion, but he said the banks have had a melt up over a reasonably long time now, but if you look at the earnings of the banks, they haven't been that great. He was asked if he thinks that shorting the banks is a good idea at this point then, and he said, well, the problem is that a lot of people are short, but he thinks that the banks are still cheap even though they've had this melt up. He said what happened with the banks at earnings season is that the earnings weren't great, but they also weren't a disaster. He said about commercial real estate imploding and affecting the banks is that it takes a while. It doesn't happen overnight. As we saw in the financial crisis, it took a while to show up. The regional banks could be affected, he said, but it could take 6, 9, 12 months if that happens. The interviewer said that they love his optimism about the economy and the melt up in the market continuing, but is there anything that he's worried about? And he said, well, he is worried if the Fed raises rates too much. If they keep on doing that, could have a negative effect on the economy and there could be a recession, but he said there's no data to support that right now. He was asked where he stands on big tech, the so-called Magnificent Seven, and he said that, well, big tech is expensive, but people don't seem to care as long as rates don't go up too much. And he said that ChatGPT and AI and all those things are very important. He was asked if he thinks that AI is overhyped, and he said no, he doesn't think that AI is overhyped. He thinks there'll be a correction at some point, but that doesn't mean it's overhyped. He thinks it's important and it's not overhyped. He said the bigger issue for him is that at the moment it's only benefiting a handful of the very big companies. He said it'll be interesting to see over the next year or so whether it starts benefiting the middle type companies. That's how he put it, the middle type companies. I agree with Eisman on this to a certain extent. I think it is currently a bit overhyped. Some of the prices, if you look at Nvidia, definitely in nosebleed bubble territory, and there are others like that. And I think there'll be a correction at some point, but that doesn't mean over the long term it won't be pretty good. I think it is a secular move, as Stan Druckenmiller said. He said it's at nosebleed levels, and I agree with that. But over the long term, I think this is a long-term secular move, and AI will play out as, say, the internet has, or even more so, that'll benefit the broader economy and maybe quite quickly, but that doesn't mean that it's not heavily overpriced right now. Now, if you're watching on YouTube, I'm going to put a link here to my previous Eisman video made just a few weeks ago. It's interesting to see how his thoughts have changed since then. And here I'm going to put a link to that Stanley Druckenmiller video, how he talked about AIs and nosebleed levels, but he's still invested. So go and watch one of those now. And thanks for watching or listening, and I'll see you in the next one.